When it comes to investing, retirement, taxes, healthcare, and estate planning, the decisions you make today can greatly affect the quality of life for you and your loved ones tomorrow. What you need is straight and unbiased information on the most important issues you'll face when planning for your retirement and financial future. Good news, you found Premier Retirement Radio with Jeff Vogan. Jeff is the founder of Premier Retirement Planning and Wealth Management, and he's been guiding people financially and into retirement for 30 years. So get ready for an hour of the most comprehensive financial information on the radio. Premier Retirement with Jeff Vogan. And now here's Jeff Vogan and Jeff Shade.
Thank you so much. Welcome to Premier Retirement with Jeff Vogan, the radio show that gives you the straight talk and honest answers you need to help you reach your wealth management and retirement goals through smart investing and careful planning. My name is Jeff Shade, and I'm just here to ask the questions. But of course, the words of wisdom and solid advice, well, they come from the other Jeff in this radio program. That would be Jeffrey P. Vogan, founder and president of Premier Retirement Planning and Wealth Management. And Jeff, I say Jeffrey P. because you and I have the same first and the same middle names. Could it be that we are brothers from a different mother? What do you think?
I didn't really think about it. Maybe so, huh? I think that's right.
That is unusual that we have the same first and the same middle names. And we ended up on the same radio show together. I guess that's what they call kismet. But nevertheless, we're glad that everybody decided to join us here on this Saturday and Sunday. Of course, we're here for you on the weekend right here on 790 KNST. As always, Jeff, we start off with talking about current events, and I want to start off by talking about some of the noise that we see on TV, we hear on the radio, and that we might read on the internet. The most recent noise is that, yippee, inflation 2.7%. That's what they're reporting for April. But we're not digging any deeper than that, Jeff. They seem to be ignoring the 25% that prices are up. Do you think that this is a common thing? I don't think there's any unbiased sort of news out there anymore. But is this common to only report what they consider to be the good stuff without digging into what's behind it?
Well, I think we have to remember that the numbers that they typically spew out of their mouths at the reporting day, the first reporting day, are typically revised one or two more times. And I think all but maybe 1 or 2 months they've been revised worse. But of course, that doesn't make the headlines, just the new estimates of growth. Now, keep in mind, last summer, the inflation rate got to its peak, and then it kind of leveled off a little bit, which is why the Fed stopped raising interest rates. So when you go back a year from now, we were basically going back from today's high levels, which actually have increased a lot since December. I think we're about 5-ish% or so in actual inflation. If you just combined just the first 5 months of the year, if you times that by 2, we're at a potential, if we keep on this trajectory, we're at a potential of 10% inflation rate for the year if we don't slow it down, because we're going back to kind of a hump in the graph. If you kind of can picture this, what I mean is the graph kind of peaked out. And so we might be only 2.7 or 3% higher in their mind from where we were a year ago, but we dropped a little bit where the inflation actually started slowing a bit. And then it's kind of gone back up. But considering that we're up about 25% since this whole inflation problem happened, we're still up 25%. So whether we're growing at 2% on top of 25% or 3% on top of 25% is really not a big deal. 1% on top of 25% is not, a life-changing matter. It doesn't really, in my mind, even indicate that we're getting inflation under control. In reality, we would have to give some of that inflation back or have a little bit of deflation. Instead, we're going through a period of stagflation where inflation is still a problem. People are able to spend less and less. The economy is growing slower. The growth rate on the economy is going down. We're 2, 2.5, 3, 4. That's kind of a okay rate. It's not healthy. 6 or 7 would be healthy. But, just the fact that inflation's growing by 2.7 and population's growing by about the same amount, GDP has to grow by at least that amount anyway, just to actually be in line with just keeping pace with, that's not even really growing. So just because the GDP reflects a small growth rate in actual numbers, a lot of that is just, extra people buying stuff, more people here. Well, shoot, you got illegals buying stuff too, with, of course, a lot of it, our tax money. This border issue is increasing our population. Population naturally grows, and inflation is hurting us. So we've got this horrible growth in GDP. And I thought it was funny because Janet Yellen, I heard a clip and I don't know where to find it again, and I can't quote it, but I can summarize that she says, well, GDP, it's really better than that. I'm sure when we see the revised numbers, we'll find out that we're doing much better than those numbers reflect, in more or less those words. Thinking, she's basically saying, we'll just manipulate it to say whatever we want. And that's kind of what the Fed's been doing. I think Janet Yellen's the least competent of all the people that are anywhere near our money. I think Jerome Powell is more of a puppet than anything, and a spokesman for whatever somebody tells them to say. But they really don't have this problem under control. And in reading some of the wise men out there, the money managers, the people that get it right far more often than they get it wrong, Jamie Dimon, Jeff Gundlach, a few of them that I've been reading lately and hearing interviews and quotes from, think that we're still headed for recession, that the Fed they're too scared to raise interest rates, even though Jamie Dimon, president of CEO of JP Morgan, says that there's probably room for one, and there probably should be at least one more rate hike, not a rate decrease, rate hike. He says, but nobody would be ready for it. In fact, I think I can find that quote really fast here. Let's see where it is. It says, do I think rates can go up a little bit? Yes, I do. And if they do, this world is not prepared for it. So I don't think it is. I think the Fed knows that, and I don't think the Fed's going to raise rates because they said they weren't, but they really have to get inflation under control. Instead, they're going to just keep saying inflation is under control, everything's good, you're really not spending more on your stuff. Your wages are higher, so you should be able to afford it. Compared to what it was 20 or 30 years ago, your buying power is still higher, so you should be happy. Well, no, nobody's happier that they're living worse than they were 2-3 years ago, are they? I mean, I don't think so. I think they're more interested in making sure the market doesn't crash than that people actually can buy bread and diapers for their kids and pay their rent and worry about, they'd rather make the market good and worry about just confiscating tax money in order to pay for the homeless and all the problems that their lack of fiscal management can deal with. So they are more likely, and this is kind of the consensus with smart money, big hedge fund managers, people that manage billions or trillions of dollars like Jamie Dimon and other big money people, that we're probably going to have to, we're already in stagflation. We're already kind of in a recession that hasn't manifested itself just because they can cover it with, the stock market's doing good. They're letting the banks out of all the crappy debt that they've been basically selling to the Fed in order for fuel injection, basically money injection, so that they can buy their own stock, they can buy other stocks, they can fuel the stock market. Nothing else is going up. If you look at all the other indexes, commodities and everything else, they're really kind of lacking or non-performing. So it's just about the market. As long as they can say, but look at the market, man, aren't we doing great? All the politicians think, we're doing great, because they're what? They're taking taxpayers' money. They're buying crappy debt from banks, basically giving them money. The banks are propping up the market and looking like everything's hunky-dory, and fine, but they're not. They're actually in a world of hurt. So I think banking is kind of topping out as far as what they can do. The Fed's only kind of done this fake money printing as much as they probably can. This quantitative tightening, I don't think, has even moved $1 trillion out of the economy, even though we've stuck 14 or 15 trillion in the last 10 years. So, and 7 or 8 just in the last 3 or 4. So we're really not undoing the problem that caused all this inflation. So what I think the consensus is, and I'm on board with it, and that is the Fed's probably going to, probably before the election, we're going to see a slip into a recession that, can't be denied, that's going to be, oh yeah, okay, this really is a recession. We're already seeing consumer goods go down, discretionary spending go down. Target stock plummeted because they're can't even sell, like I said before, can't even sell $10 pants and $5 t-shirts anymore to enough people to make a profit. McDonald's has got to go back to a $5 cheapo meal because nobody can afford a Big Mac meal for $13. So everybody's kind of trying to figure out how to deal with this inflation problem and have consumers actually be able to consume. And if they do that, they're going to do it at a much lower profit than they have been. So companies are not going to be profitable. Earnings already stink. I mean, earnings might be non-existent for a lot of these companies while we try to figure out this inflation problem. So a recession is probably inevitable. As we get into inflation, if it happens to even look like it's before the election, that the Fed's going to prop it up. And you know what they're going to do? Probably going to lower interest rates. And we're going to have this second wave of massive inflation because of the extra liquidity that they're going to pump into the market. And if that happens, then the world's a worse place. But hey, it's after the election, and maybe they got a chance to put their guy back in. So, I think it's massively manipulated. We can bet on the government to manipulate it and jump in the market and just hope this train doesn't crash. Or we can say, you know what, there's no real fundamentals driving this thing. Maybe we ought to, go to someplace a little bit safer and kind of wait till the crash is over before we try to pick up the pieces and move on. So, I think there's a lot of concern for what we're looking at economically. I don't think that we're in as good a shape as they try to make the bad news seem, because you said that, they're trying to only pick and choose the good news that they can tell us. Everything that they tell us is bad news. I've been saying that since they said they were going to lower interest rates. I said, no, they're not. Inflation's not under control. It's not. And so when they tell us these things, but they say, it's like the emperor's new clothes, like, oh no, look at these beautiful clothes. And you're looking at it like, there's no clothes. I mean, I'm not seeing anything there. The guy's naked. The market's naked. The whole situation, there's nothing on it. Why are they saying there's something on it? But they say it enough, you're like, oh, well, gee, everybody else believes it. Well, maybe I'm just blind. Maybe I'm just not seeing things right. Well, okay, we'll just go with the flow. And then we just become lemmings, following the crowd off the cliff eventually. So we've got to be careful to, keep these things in perspective. And I think when it comes back to money, they're basically BSing us. It's just one BS after the other. If it's good news, they try to make it good. If it's bad news, they try to make it good. They spend everything to make it look like everything's just fine. But I mean, if you're out there spending money and shopping at the store and trying to buy stuff for your family, Christmas presents for the grandkids, it's a lot tougher than it used to be. I mean, even for people that can afford it, we still notice prices being higher. It's like, wow, dang, never thought about buying this before. Now I look at the price and go, do I really need it? It makes you rethink when you see everything going up in price. So, I don't think there's a real quick fix it. Either they force a crash and a reset so it can just get over, like ripping off the Band-Aid so we can just get the thing done and move on, or we just keep on digging this hole deeper and deeper, and there's going to have to be massive repercussions when everything from government debt has to reset, and anybody owning long bonds loses money because they reset like they had to do in the pigs countries. I mean, we can get into this is a whole new conversation, but there's all kinds of bad looks ahead if we keep on digging this hole and have to fix it later. I think the sooner we fix it, the better off we'll be, the more chance we have to regroup. But nobody wants it to happen on their watch, right? The politicians are all more worried about being elected than doing the right thing for the country. And they're all about doing the right thing for themselves and, keeping their own job and keeping their own little cushy place in there where they can do their insider trading and be in control and have power, all at the expense of the American taxpayer and even the American non-taxpayer. But Americans are not winning here. Politicians are trying to do what they can to win. But I don't think America as a whole is winning. It's kind of hard to win right now. But, there'll come a day. Cycles always repeat. Cycles always complete. And I think this cycle will too. I just hope it's I think I've given up the idea of a soft landing or no landing. I think it's the longer they stretch the rubber band and pretend it's not going to happen, the harder it's going to be when it finally does reset. So I think everybody needs to, err on the side of caution, be careful about the type of investments that you make and make sure it's more about not losing money than it is about trying to hit home runs and beat inflation, because I don't know if that's possible right now when things are a little bit out of control.
We're talking with Jeff Hogan of Premier Retirement Planning and Wealth Management here in Tucson and Mesa, and we're talking about the economy and the market, 2.7% inflation rate the month of April. And we're talking about what to believe and what not to believe, turning down the noise on the TV and on the radio and in what you read. If Jeff's thoughts resonate with you, you want to get in and sit down with him, talk about your individual situation, your retirement roadmap. We're offering that right now for you, no cost and no obligation. It's an opportunity for you to sit with Jeff, ask your questions about the market, the economy, and your journey towards a confident retirement and what you can do and what you should do. Our telephone number, in order to get that, 520-780-9059 is 520-780-9059. No cost and no obligation. You can make that call this weekend, as in right now. Leave your name and telephone number. Shelley will call you back during the week and set up that appointment for you. Again, no cost, no obligation. So make that call today, 520-780-9059. If you've been doubtful that you're on the right track, this is an opportunity for you to get on the right track. Again, our telephone number, 520-780-9059 for your no cost, no obligation Premier Retirement Roadmap. You can also request it online at premret.com. That's PREMRET.com. Well, Jeff, we were talking about what you hear and see on the TV and on the radio. It's sort of like the tale of two cities. Some people say there's going to be a summer rally. Others say there's going to be summer doldrums. What camp are you in?
Well, I think, we've already kind of pumped the market about as full as I can imagine it being pumped up, given the fact that it's up 10 or 12% year to date. And, even though we've getting this kind of bad news, the market's been a little choppy lately. It's been more resilient than I think it probably should be, given the fact that there really hasn't been robust earnings other than NVIDIA coming in again with high earnings. You've got The companies that are coming in with higher earnings are typically the tech AI companies, and just a few and far between those. Many of them aren't really doing that well. They all say, oh, we're going to have a chip, we're going to do this, we're going to make sales, and they have good, what they call guidance going forward, but nothing's really materialized yet. So we're still getting just very few stocks are contributing to the gains of the S&P 500 or, are actually responsible for them. Yet the market seems to kind of drag along. People keep believing that somehow we're going to have this surprise earnings next year. Last year the market rallied 25 or so %, depending on, where you started and how far down the bottom was, but it rallied back to about break even. And now it's up, 8 or 10% on the NASDAQ, higher than it was. S&P is up a little bit. I think Dow's close to break even, but for the last 2.5 years from when it started down. So people are looking at this last year or two as if this, oh my gosh, look at all these great growth and earnings. Well, remember, we took a big dump in 2022 and it's just barely come back. I mean, if we hadn't lost that money and you would have made 4 or 5% a year, during those 2 years, you'd still be about where the market is if you're looking at the indexes, unless you've been really lucky and surgically picked the right stocks, like NVIDIA for one. But that's, again, is that overly hyped? Is it overly priced? A lot of people think so. Can you bet everything on one stock? Well, if you're young and crazy, sure, go for it. But if you're, trying to retire and save your money, probably not a good idea. This market has been a little bit choppy. It went up a lot last year with almost no earnings. So all the losses from before really haven't been recovered. Companies have still laid off tens of thousands of people in some cases. Google's going to lay off another 100 employees, high-paid employees in one of their departments. I mean, they're all shedding employees because they can't afford. They need to cut costs in order to continue to make it look like they're making earnings. Some of these big, Magnificent Seven stocks want to at least look like they're still pulling their weight, and it's really hard to without them cutting overhead. Well, if you cut all the people that develop products and make your company grow and run the place, how are you really going to grow? How are you really going to make sustainable earnings? You can't. You can just fake it for the next quarter or two on your earnings and make the stock look like it's justifiably trading at the price levels that it is. But that'll all come back to bite them in the rear eventually. There'll be a recession and everything will reset, and companies are going to have no choice but to start hiring back those people and, trying to regroup and build back up again. But the stage has been set already, and basically the seeds have been planted for a recession just in the fact that companies have been scaling back. They haven't been in growth mode. They haven't been making earnings. They've had, in order to even keep their earnings flat, they've had to decrease overhead by abandoning things like, Meta, the metaverse. They're not even doing much on that anymore. They're just talking about AI chips and, selling Instagram ads, and that's how they're making all their money. Google the same. Are they developing, their technology platforms like they were? No, they're letting those go. So a lot of the companies, and then you've got China banning certain technologies, certain chips, Apple's struggling there. Other big companies are struggling there. So we've got a lot of just fake appreciation in the market already. I'm honestly surprised it's up as high as it is. Typically in an election year, the first half of the year is choppy and flat. The second half of the year is where you see that 8 to 10% growth. Well, we've already seen that. So it would not surprise me at all that the summer up through the election is very flat, maybe even down. And we may even have that recession that everybody's been kind of waiting for, but somehow stopped believing that it was going to happen because of the fake rumors that they're going to lower interest rates. And obviously low interest rates are effective, ways to help companies earn more money, especially those companies in the tech business and other industries that borrow a lot of their money, that need capital to run, that have an interest rate aversion to high interest rates, are going to get some sort of a reprieve, and they're going to end up going up again. But the fact is everybody says and everybody sees that, has half a brain and understands economics even a little bit, that the Fed can't just lower interest rates, even with or without a recession, without causing more inflation. So we may have a recession and then a double whammy inflation after that, because the Fed's going to overreact to try to soften the blow and soften the market contraction by manipulating interest rates again. Honestly, we ought to just get the market back to where it's fairly valued and start over. I know that means a lot of loss for some people that want to ride it down and ride it back up. Eventually it'll come back. It always does. But, if you're using that money, for example, most of our clients are retired or close to retirement. If you're going to use that money, you don't want to be riding the market down and riding it back up. We want to go maybe enter again when it's fairly valued, when it comes to that cycle where it always ends up going back to, even though they say not this time, it's different. The government's printing money now and they can keep it from happening. Well, they keep on saying they've done something different and keep it from happening, and it seems to happen all the time. So you've probably got decades ahead of you as far as needing to use that money. We don't want to have another lost decade and have a 30 retirement years spent just waiting to catch up or waiting to figure out how you can live just on Social Security or a small pension while you wait for your investments to come back. So we have to be careful. I think the market is very likely going to be flat. I think we might even see some softening. That's just my prediction. That's just my guess. I'm not predicting because honestly, I've been so wrong. Just in light of the fact that we haven't had earnings yet, we've still had this robust growth in the market. So could it continue to be manipulated? Yeah, but it just seems like it's running out of steam to me. And I think most of the smart money people look like it is too. We're seeing a lot of action in the gold and silver market, which is typically a hedge. When smart money thinks things might get bad, we had breakouts in all the precious metals recently. Copper's also at a high demand now. We've got gold and silver, even uranium, because of all the energy needs from all this AI craze and the fact that we're going to need, even nuclear power is getting kind of a rebound. So we've got a lot of places that we're seeing some money and interest flow that are not stocks and bonds right now, which means maybe the smart money's kind of tired of riding the train and kind of getting off and going to places where they think are more of a hedge. What I'm not seeing is people, unlike the first of the year when they were kind of jumping on bonds, thinking the Fed was really going to lower interest rates at first. I think a lot of people believed that, so they went into mid and long-term bonds. We even did that for a minute, thinking that, well, okay, if they're going to do that, we might as well get on the train. I mean, all the smart money is going there, and all of a sudden it flipped, and the downtrend, even since December, it's really been a bond downtrend. In other words, interest rates have effectively still been going up a little bit because the price of these mid and long-term bonds are going down. So bonds are not really the play unless you want to lose some money in the face of rising interest rates. If the Fed starts lowering interest rates, then bonds may be a play. But until that happens, I'm just not willing to take that bet anymore because the Fed's misled us too many times before. So we're seeing some things in the market, to me, and I just mentioned a few of them that indicate that, yeah, we are kind of at the end of the rope here. There is a saying, go away in May and take your profits, because typically May through November is a soft time in the market. A lot of people take vacations. They don't want to look at the market. Some people just go to cash, kind of take the market off. They don't want to stress about it. Wall Street kind of takes a break. And so historically, it's kind of a slow time in the market anyway, except in election years. Sometimes you get a rebound kind of mid to late summer just before the election. We'll see if that happens. I think we already had it. So, I don't think we should be jumping into the stock market right now thinking you're going to make a whole lot of money between now and the end of the year, unless you are really picky about certain stocks that, got new government contracts or have a new product or a new service or some new revenue stream that they didn't have before is really the only thing that would make some companies probably good buys rather than most companies, which are already priced very rich compared to what their market valuations are and their earnings and growth are.
We're talking with Jeff Hogan of Premier Retirement Planning and Wealth Management here in Tucson and Mesa. We're talking about current events and turning down the noise. Jeff, just a couple minutes left in the program here today. For the rest of the year, rate cuts or rate hikes? What's your opinion?
Well, it could be both. I know I addressed both of them in our opening half of the show so far. Jamie Dimon says he thinks there's room for another rate hike. He's one of the smartest financial guys, and he seems to be dialed in pretty good with even what the Fed's doing and what they're going to do, even though he did kind of play it up to his own benefit when they said they were going to lower interest rates. He said, yeah, lower interest rates. They're going to price them in. All the while he's going I don't think so. I think they could actually have one rate increase if inflation doesn't get under control in the next couple of months. And that will probably kill the market. We'll go into massive recession, and then they'll totally undo it really fast and probably have some rate decreases, which will try to save us from going into full-blown recession right before the election. This is me honestly, don't hold me to this. This everything, nobody has a crystal ball. But I think this could be a scenario. If Jamie Dimon's right, it'll probably happen in the next, probably by September. And if it does, it will probably rock the market to a degree that they'll have to backpedal very quickly, and then they'll drop rates. If we don't have a rate hike before the election, I think we might see inflation continue to get worse. I think the economy will get worse. It'll be obvious that the economy is worse. And I think the Fed will drop rates sometime before the end of the year in either scenario, just to try to fix the recession or to make it look like they're doing a good job to save the economy. They're not going to save the economy. They're going to save the market, and they're going to cause another wave of inflation. That's what I see happening. So we have to be careful and be really smart the way we invest and the way we take care of our money. the way we budget, and the way we plan our income for the future.
If you'd like to get in and talk with Jeff at Premier Retirement, get your no cost, no obligation Premier Retirement Roadmap. Very simple to do. You can make that call right now. 520-780-9059. Go ahead, make the call this weekend. Leave your name, telephone number. Shelley will call you back during a week to set up that conversation. Why not take advantage of an opportunity to get the questions answered that you need on your path towards a confident retirement? Once again, 520-780-9059 is our telephone number. You can also find out more about us online at premret.com, PREMRET.com. Jeff, time for a break. When we come back, listener questions and more when Premier Retirement continues right here on 790 KNST, Tucson's most stimulating talk.
You can't start a trip you've never taken without a plan, and you can't start your retirement journey without a comprehensive plan to get there safely. To request your no-cost Premier Retirement Roadmap, call 580-780-9059 or request it online at premret.com. Now back to more Premier Retirement with Jeff Hogan and Jeff Shea.
Thank you so much for making this a part of your weekend. You're listening to Premier Retirement with Jeff Hogan, founder and president of Premier Retirement Planning. And we're here for you every week for your fiscal fitness, your financial education, right here on 790 KNST. Again, we're on 4 times a week, Saturdays at 7 a.m., 9 a.m., and then at 1 p.m., and Sundays at 11 a.m. If those times are not convenient for you or you'd like to hear the show again, maybe you missed something, you can always join us in our podcast. We are a podcast. Go to wherever you get your podcasts, all the major podcast platforms. Search for Premier Retirement with Jeff Hogan. You'll find this show and all of our past shows so you can stay on top of your journey towards a confident retirement. Okay, Jeff, time for listener questions. Again, this week we have 3 of them. We'll start with Jerry listening to us in Rita Ranch. And Jerry says, my wife and I are both 56. We have around $1.2 million saved. Approximately $458,000 of that is in company 401k, $650 in managed accounts, approximately $70,000 in personal stocks. We have approximately $22,000 in cash savings. Our home is worth $700,000. We owe about $197,000 on that with a 3.8% interest rate. Our advisor says that we'll be in pretty good shape by 60. That would be, 4 years from now. We'll withdraw 5 to 8% from our investments and then take Social Security at 62. Do you think we'll be able to withdraw between $60,000 and $80,000 annually and still be okay as long as our advisor makes us at least 5 to 8% per year annually?
Well, your advisor is not going to make you 5 to 8% annually. The market might, the interest rates might, the Fed's more in control than your advisor, the stock market's more in control than your advisor. You have to make decisions based on possibilities. The other thing is 5 to 8% is not going to be an annual rate of return. It might be the long-term average, and I don't think that's unrealistic at all. I think 5 to 8 is okay. The stock market over long periods of time averages, better than that. However, we had the lost decade of 2000 to 2010, where the stock market went up a couple of times, crashed a couple of times, ended up making zero. Let's just say you spend, you've got 1.2 million, and just say over the next, I'm going to give you 2 scenarios. Let's just say the market doesn't crash, that you kind of hold your own. Let's say you have $1.5 million by the time you retire, and you want it because you have $1.5 million. The answer is, let's just take 80,000 out. That's roughly 6%. So not a big deal. Actually, it's a little bit less than that. So 5.5%, 6% withdrawal rate, and you're taking the money out. But let's just say you don't make any money. The market's up and down. But let's just say it's flat for the next 10 years. Doesn't make any money. Okay, well, you just spent $800,000 of your $1.5 million. Now you're down to $700,000. And then the market starts going up again and gets back to that average. Then what? Do you think spending $80,000 or having a 10 or 12% spend down rate is really going to make a difference? Even if the stock market goes up 20%, you're just holding your own. It's not going to go up 20% every year. The other thing that might happen is, what if you have a couple of crashes in the middle of that market where it's actually volatile and still ends up at the zero rate in 10 years, but let's say right out of the gate, you lose 50%. So let's say your 1.5 million goes down in a year and a half to 7.5 million while you're spending $80,000 a year. Well, you just spent $160,000 plus it went down half. So now you've got, again, you're down to about $700,000. Oh, but let's say the market comes back and averages 20% for the next 5 years and gets back to break even. Well, 20% for the next 5 years. So let's say you're making, 140 for the next 5 years. So you make, so let's say you're back up to maybe $1 million. Even with that, just robust earnings. So let's say that means you have to make 20% every year, not have a bad year. And then the market crashes again like it did in 2008, another 50%. So now you go down to $500,000. Oh, but wait, while you're going down $500,000, you were spending your $80,000 still for another, 3 years. So now you're down $240,000. So now you're down to about $300,000. Oh, but wait, the market's going to rebound and I'm going to make 20% a year again. So now you're spending 80, but only making 60. And guess what? You're out of money in 10 years. So if the market has a roller coaster ride, it doesn't work. Volatility will kill your plan. I tell the story about Norm. This is the story about Norm. Your broker is going to get you just as much trouble as Norm was in by not honoring volatility. If you can get a bond or an equity account that guarantees 5 to 8% for the next 10 years, great, do it. Guess where you can get that? You can get that in annuities. Never lose money, have 5 or 6% guaranteed for the next 10 years. And guess what? You'll be guaranteed to have, still have at least $1.2 million after the next 10 years. You might not double your money, but guess what? You're not going to be out of money either, like you would the other scenario with volatility. So I would say you probably need a more comprehensive advisor that's more into protecting money than just giving you a long-term average and expecting them to play out. You got guys on the radio like Dave Ramsey. I hate to cut another guy on the radio, but the guy doesn't understand volatility and planning. He understands growth and that's it. And he understands paying off debt. That's great. Mm-hmm. But, you get a lot of people that just talk about average rates of return. Well, you can average this. Guess what? Averages not make anything. It's a sequence of returns. And there's a thing called sequence of returns risk that will kill you. Right now, the market is super high, overvalued, historical. Do you know what the betting odds in Vegas are that the market will average, what the range is that the market will average in the next 10 years because of where the cycles we're in are, because of what history shows? It's about -2 average rate of return for the next 10 years to a +2. There's a 4% margin. -2 to 4% is what history tells us the next 10 years will average as far as a rate of return for the stock market. Now, we'll probably have 5 or 6 good years and 3 or 4 bad ones, but they will average 0 if you look at actual averages. Now, if you look at annual averages, which is another way that they kind of fake you out into believing the market's better than it is, let's just say the market goes down 50%. And then it has to go up 100% to get back to even. What's the actual rate of return? It's 0 because you went down 50 and up 100. Now, if you take -50 plus 100, what do you get? You get plus 50. If you divide that by 2, it's 25. So if you want to twist the information and play word games, you could say the average rate of return for the last 2 years, because we had one at -50 and one at plus 100. Now, it won't do that in 2 years, but I'm just saying during a period of time. Is that really averaging plus 25? No, it comes out 0. But you could say it averages X. Now, I'm using an extreme example, but that's how sometimes if you're not careful about how they're reporting average annual returns or average annualized returns, they're different things. And so you have to be careful on what you're getting pitched to you and how you're getting sold, because too often we're sold on the numbers and we think, oh, well, surely Vanguard or Fidelity couldn't print that number, or so-and-so. They're regulated. They could never print average annual rates of return like that. And if they weren't true, well, wait a minute. Make sure you know what they're actually telling you. If you can just buy and hold and wait it out, that's one thing. But if you're spending money, it's a totally different story. So Jerry, no, I don't think that's even possible. I would never say I can make you 5 to 8% so you can draw 60 to 80%. You should just keep it in stocks and bonds in the market. However, if you use LIRPs, life insurance products that have principal guarantee with upside, if you use fixed index annuities with income riders, I could show you how at 60 years old, for just $1 million of that money, you'd get about a $60,000 a year guaranteed payout for life, regardless of how well it worked. And if you could add another $200,000 or $300,000 in savings plus some growth over the next, 3 or 4 years when you want to, retire, then you've got $500,000 that could be all your discretionary, and you can pull money out of that whenever you feel like it. That plus your Social Security would be a lot more sensible way to not worry about risk and not worry about market crashes and not have to let it wipe you out, because you'd have that guaranteed income for life. Guarantee the income to the extent that you need to support your needs for your lifestyle, and risk the rest if you want to risk it. Now, you don't have to risk the rest. You could even put the other stuff in a principal protected type of an account or something that's a lot lower risk, still average 5 or better, not run out of money, but never have to take a loss if you need the money when the market's down. Bottom line is volatility kills retirements. Nobody tells you that. Am I the only guy? I mean, there are people out there that do. I might be the only guy in town on the radio that says that. Everybody else says, oh, just hang in the market, just ride it out. It'll always come back. Well, that's great. If you're the broker dealer that manages money and you get fees over and over forever. If I was in that boat, I wouldn't want you to spend money either. I want you to just leave it in there and just wait, just let it. Well, wait a minute. You saved that money so you could spend it. I want to help you spend it. I like happy clients. I like clients that are paying all their bills. I like clients that don't lose sleep at night. I don't like to lose sleep at night over my clients' money. So honestly, that plan, I would lose total sleep over that money if I gave somebody an indication that as long as we make 5 to 8% a year, you're just fine. Keep spending the 60, 80, because guess what? I know that you're not going to do that every year for the next 30 or 40 years. There's going to be some glitchy moments in there that's going to kill your plan. And nobody, your advisor, can't make that not happen unless he uses principal protected guaranteed products that insures your account from loss. And there's just far too many people that are Wall Street only people. And then there's also people that are annuity only people. I think you need a combination of both. But you can't be a one-trick pony and ride just the one horse into retirement and expect it to be a fix-all for everything that might come, because there's nothing more unpredictable than markets. Well, the only predictable thing about markets is they're unpredictable. You can't count on them, right? You can long-term if you're not using the money, but if you're using your money, you need something a little bit more predictable, a little bit more guaranteed. And that's why we do retirement planning and retirement transition planning. And it's all about income. It's not about growth, and it's not about risk. We try to take the volatility and the risk off the plate and do proper risk management so that you can sleep at night and know you're not going to run out of money. We've heard that this is the only thing worse than dying is running out of money. We don't want you to run out of money. We don't want you to die either, but we know that's inevitably going to happen. But we can probably work around the other one. We can't say you'll never die, but we can put it in a situation where you won't run out of money if you do it right.
Jerry, thanks for listening to us in Rita Ranch. And again, I would highly encourage you to call Jeff, sit down, get a second opinion on your situation. 520-780-9059 is that number, 520-780-9059. And Jerry, we'll send you out Jeff's book, Retirement: The Road Ahead. We're talking with Jeff Hogan of Premier Retirement Planning and Wealth Management here in Tucson and Mesa. Before we get back to the program, I want to remind our listeners today, Jeff, that we're offering a no-cost, no-obligation, no judgment opportunity for people to come in and sit down with you and talk about their retirement portfolio and where they're going with retirement to get the questions answered. Now, it's not going to cost you a dime to have this conversation. That telephone number to call to take advantage of this opportunity is 520-780-9059. 520-780-9059. I know it is the weekend, but you can make that call right now if you want. I would encourage you to do that. All you've got to do, leave your name and telephone number. Shelley will call you back during the week and set up an appointment for you to come in and sit down with Jeff on a one-on-one basis to get your questions answered to help you decide if you're on the right path towards a confident retirement. Okay, Jeff, next question from Ron. He's in Tucson, and Ron writes, I retired at 60, enjoyed life for 18 months, and then found a seasonal job for the next 2 years. Each of those years, I made substantial Roth conversions. Can I contest IRMA adjustments on the grounds of retiring after the age of 63 if I stop my seasonal job at 63? I think he might be a little confused about IRMA. Jeff, can you set him straight?
Yeah, IRMA actually is the income-related Medicare adjustment. It's based on your income. If you make, like right now, it's $174 a month for Medicare Part B. That doesn't even start till you're 65. So I don't know how somebody who's 60 or 63 is worried about it yet, other than the fact that there is a typically, if you get in an IRMA problem where, for example, I have a client that worked at the mines. I mean, he was making close to $500,000 a year, and his adjustment for Medicare Part B, because he wanted to retire at 65 and go on Medicare because his tax return was so high, he's paying over $400, about $420 a month, which is kind of maxing it out. Now, you can pay $174.70 as long as you go under the first bracket, which, the first bracket, it's a modified adjusted gross income, so it's kind of a weird thing. You don't get some of your deductions, but if you make $103,000 or less as a single person, then you pay at that level. If you make $206,000 or less, if you're married, then it's $206,000 before the Medicare starts creeping up again. So again, you've got to look at what you're making, make sure that you don't show a big tax return. If you do get hit with it, you can sometimes say, hey, I made a one-time Roth conversion. Let's say if you are 65, and this isn't going to even affect you at 63, but if you were 65 applying for Medicare and you had a big Roth conversion and it was a one-time event, you can typically appeal it. And normally Medicare will give you a one-time appeal. Okay, we'll give you a break this time. But if you keep doing it year after year, they'll stop giving you the break. You can't just do Roth conversions forever. So keep that in mind. It might be smart for you to start Roth conversions in your 60s, between 60 and 65, or 55 and 65, depending on, when you stop working. Now, if you stop working at 60 and you're not going to go on Medicare till 65, that's a great time to do all your tax planning in your early 60s. Pay all your taxes now on less money, do Roth conversions, get set up with taxes, and then show the IRS that you have a low income so that the extra dollars you pay for your Medicare Part B doesn't go up with that income-related Medicare adjustment. that's something that we have to think about. And sometimes, even if you get started late on your tax planning, sometimes it's worth paying a little extra in Medicare just to get rid of the tax burdens that you might face in the future. So again, it all needs to be looked at. You asked a great question. It would affect you more if you were over 65 and had that part-time job and you had, make sure you were keeping under 103 if you're single, or 206 if you're married, based on 2024 rates. It'll go up probably in the future.
Ron, thanks for that question, and thank you so much for listening to us in Tucson. Of course, we will be sending you out Jeff's book, Retirement: The Road Ahead. Jeff, next question is Cheryl listening to us in Vail, and Cheryl says, my son, who is 18, has just graduated from high school and has been accepted at Arizona State University in Tempe. He has always excelled at math and is considering a career in finance, particularly financial planning. With AI threatening many things, do you think that there will be always a future for human financial planners? And what should my son do to have the best chance at success?
Well, I don't know your son well enough to give him great advice, but I will say, I'm happy I went into this business. I was really good at math as well, aced my SATs in math and loved engineering in math. But I just didn't love the engineering wing as much as I enjoyed the business wing. I ended up getting a finance degree and kind of tailoring my career this way. But I have always seen over the years that how like the broker dealers or insurance companies have tried to direct sales and do all their marketing without agents, without humans in the field. And they've tried to basically replace guys like me since I've been in this business. AI is another way to replace guys like me, but there's always going to be a place. I have not had a feeling that there's a whole lot that can replace the human experience. I think humans like humans, and I don't believe that we're ever going to be okay just sitting in front of a computer and letting a computer somehow plan our future. The other thing is, I think as AI gets big, just to kind of dispel this myth, is I don't understand how AI can make the right decisions for everybody. From a standpoint of maybe trading stock or day trading, you can probably find some algorithms that would probably help you with AI. But I don't understand how an AI system would be able to really listen to your values and goals and create a plan that would create income other than it would just product pick. If you just want product picking, you can go on the internet and just type in fixed index annuity and see what one gives you the best sales pitch online. You can also buy an AI bot and do some day trading and see how that works. It might work great until your last trade that doesn't work. I don't know. You may end up hating it. But I found that most people, when it comes to your money, maybe wants a personal touch with that, where you can kind of get the feeling from each other, from the advisor, for one can get the feeling from you of what you really want or what makes you tick and what is important to you, so that, they can create the right peace of mind and not just some stale plan that's supposed to work in certain situations. But if there's another AI that maybe is on the opposite team that wants to win by making your products not work so their products can work, I think AI could get into a big fight where you're still going to have to, get to know which AI model is right for you. Just like right now, people have to decide which fiduciary advisor is right for them. Just because everybody calls themselves fiduciaries and is trying to do the right thing for their client based on what they know and based on how they understand the client's needs and wants and the products and services that they offer, everybody's a little bit different. I have a different flavor of how I do business. I consider myself a fiduciary. I take that term very, very seriously. And based on what I know of the client, I make my best recommendations based on what I think is the best. Now, does the client always think, no, not everybody does the business here. They find a fit elsewhere sometimes. I think the people that do find a fit here find out that, we are in line and, we can find a fit and make this plan work long term. And we just have to kind of stick to it and see how it plays out and stick with the plan instead of trying to jump from one thought to another. But there's always this AI thing is really, I think it's maybe a little overblown. I think there's a lot of automation maybe in the manufacturing business where it's going to be a little bit more job displacing than I think those places where personal relationships have been important. I consider the premier retirement and wealth management is more of a family type of business. I'm not a super big operation. I don't want multiple offices. I don't want to babysit hundreds of reps and try to make sure that they're doing the right job and just out picking up clients just because they passed the mirror test and can breathe and have money. My thought is let's build a family, have a relationship where we understand one another, where they understand what I can provide and what my scope of services and expertise are. And I can understand what their goals are and make sure that they can live within those parameters, not spend too much money, spend more than they think perhaps, but not run out of money because we're, managing those assets to be safe during good times and bad and risking only the amount that we can afford to lose, creating income streams, creating tax savings, creating a plan for long-term care and creating those things. I don't know that you could just plug that into an algorithm in AI. Maybe you can, maybe you can't. But I think, I'm old school, and I think there's enough people out there that are going to continue to be old school, even the peers of someone who's 18 years old, that I still think in 30 years that there's going to be room for that. And what if there isn't? There's still going to have to be somebody like your son to have to program those AI models that are going to go out and run people's plans. So I don't think of a career in finance and financial planning and, all the things that certified financial advisors and planners, do for people are going to be irrelevant. They might just be done and maybe provided or distributed through different means. But I don't think that means that he's going to go into a dead career by any means. I think as the economy in the country grows, there's going to be more and more wealth. There's going to be more and more wealth passed on to younger generations that have no idea how to manage it, grow it, or do anything with it. Because I think, the generations that's retiring right now, I think is probably the wealthiest generation that's been around for a while. And there's going to be a ton of wealth over the next, as the baby boomers retire and die, ton of wealth passed on. So there's going to probably be a lot of your son's peers that are going to need help doing stuff with that money, not just sticking it in an automation bot that does trading for them until they retire and sees what happens. So I think there's going to be always a place for personal relationships. If there isn't, then the world just fails to be a world full of humans. I think humans have done a great job creating AI and to aid them as a tool. But I still kind of dismiss the notion that AI can actually fulfill its own destiny and, eliminate humans altogether. I don't see that happen. I still think we can stay in control as humans.
Cheryl, thanks for listening to us in Vail, and we highly encourage you to encourage that young man to go ahead and pursue a career as a personal financial advisor. I think there's always going to be room for one human being talking to another because, as you said, with AI, it can't really do lifestyle planning. It can't really understand who you are, what your goals, your needs, your visions for retirement are. So, Cheryl, again, thanks for listening to us. We'll send you out Jeff's book, Retirement, The Road Ahead. If you've got a question you'd like us to answer on the air, we suggest that you get it to us by going to premret.com, premret.com. Use the contact page there to send us that question. If we answer it on the air, of course, we'll be sending you out Jeff's book, Retirement, The Road Ahead. Once again, our website, premret.com. That's premret.com. Jeff, last week we had a question from a gentleman who had $550,000. He's still working. He doesn't know if he can retire. What do you think about that fellow possibly test driving his retirement, trying to live on what his monthly income would be off of $550,000?
Well, I think it's smart for anybody if they have a chance to do that. Unfortunately, too many people come into my office with a date like next Friday that they're going to retire and they want to convert their 401k into an income stream and want to know how much they can live on. And then they have to adjust their spending to whatever that can generate safely and predictably and on a guaranteed basis or, tax efficient basis. So, we can reverse engineer a plan, but if you actually go into retirement and say, okay, what are my actual expenditures? Keep a tight look at what you're actually spending. Because I know somebody might make $150,000 a year, but by the time they put their money in their 401ks, pay for their benefit packages, pay their union dues, or pay for their portions of 401ks and Social Security and all the other things that get deducted out of a paycheck before you actually take home that certain amount, you might find out you're living on half or you're living on 75,000. So, you might think your income's 150 and in retirement, you're going to need 150. You probably won't. The rule of thumb is 70%. Well, that doesn't necessarily even mean anything either. Maybe you had a house payment, you finally paid off your house, and you just got rid of $2,000 a month in expenditures the same time you retired. Maybe you're not going to buy a car every week because your 50-mile round trip commute is gone and you don't have to drive as much. There might be a lot of things that you save as far as expenditures. So, I would definitely try to get a good picture of what that would be. And, maybe even find a plan out and say, hey, okay, if I do this, how much would I be able to live on comfortably, and then see if it works. I mean, I've done that on the fly a few times, and typically we can make it work. But I've also seen it happen where on the fly, people get kind of bummed and kind of wish they'd stayed at work a little longer. They probably wish they didn't retire at 62 and take Social Security early. Maybe they should have worked till 65 and at least got on Medicare so they didn't have to pay for their own health care premiums. And that would have added maybe several $100s a month of monthly income to their retirement for the rest of their lives for decades. So I think the test drive is a pretty good idea. I think what we do by making a plan is by kind of giving it a good test drive look, but you have to compare that to actual expenditures. And it's not hard to find out your budget, even if you haven't kept the budget. Hate the B word. I like spending plan, but you can just go back and look at bank deposits, look at your tax returns. You can find what you're spending money on. if you just look at your credit card receipts, find out how much is discretionary, how much is needed, and then make sure you have enough. And if you don't, work a few more years. If you don't like working that bad, then adjust your lifestyle.
Jeff, we're out of time for this week. I want to thank you for your time and remind our listeners certainly that if you'd like to get in and sit down with Jeff, talk about your retirement journey, our telephone number 520-780-9059. Make that call this weekend, 520-780-9059, or online at primrat.com. Well, Jeff, as I said, the clock is our enemy this week. I want to thank you for your time, but most importantly, of course, thanks to our fine listeners here in the greater Tucson area. For Jeff Hogan, I'm Jeff Shade. Have a great weekend. Talk to you next week with another edition of Premier Retirement right here on 790 KNST, Tucson's most stimulating talk.
Investment advisory services provided through Premier Wealth Advisors, LLC, an Arizona state-registered investment advisor. Securities transactions are placed through TD Ameritrade. Insurance and annuity products are offered through Premier Advantage Inc., DBA Premier Retirement Planning and Wealth Management. Investing involves risk, including the potential loss of principal. Any reference to protection, safety, or lifetime income generally refer to fixed insurance products. Insurance guarantees are backed by the financial strength and claims paying abilities of the insurance carrier. The show is intended for informational purposes only and is not to be construed as advice or recommendations. Due to show format, accuracy, and completeness cannot be guaranteed. Premier Retirement and its representatives do not provide legal or tax advice and may only conduct business with residents of states and jurisdictions where they're properly registered.